Good morning. Welcome to Market Monday. Last week, the Federal Reserve hiked rates another 0.25%, also indicating that the hiking cycle is nearing an end. This was one of the most debated Fed decisions. As Matt mentioned last week, the Fed already hiked till it broke something, namely the bank failures and associated ripples throughout the global banking system.
On one hand, you have at least four prominent former Fed vice chairs, Larry Lindsey, Roger Ferguson, Bill Dudley, and Rich Clarida, all calling for another hike, as not hiking would signal there's more turbulence underneath the surface than there really is. It would signal that the economy is weak, which would diminish confidence and cause lower borrowing and spending. Headline CPI inflation is also still far above the Fed's 2% target, and unemployment remains low. All good, right? Bill Dudley goes on to say, quote, "This is not 2008. The largest banks are more resilient with bigger capital buffers. Households and businesses are in better financial shape. There's no housing bubble, inflated in part by opaque, complex financial instruments."
On the other hand, we have had bank failures, and the ripple effects have yet to be felt from that. We're seeing auto loan denial rates at the highest rate in 6 years, though we've seen these levels several times in the past. We have 11 straight months of month-over-month declines in leading economic indicators, LEIs, a streak never seen before without the economy already being in or heading into recession. What's so wrong about the Fed coming out and saying, "We see what's going on here, we're on top of it, we're remaining data dependent and making the best policy decisions given the current circumstances"?
Not only that, we have median home prices finally falling by 0.2% in February, the first year-over-year decline since 2012. Remember shipping and freight in 2021 and 2022? Now at the 2020 lows. Gas prices in the US are 84 cents or 20% lower than a year ago. Barring a big spike higher, this should be a big factor in pushing down March headline CPI inflation. But we all know this, right? We talk about it here every week. The Fed knows this, right? And what about the long and variable lags the Fed itself states over and over?
Here's a live look at inflation. We say live look because the service, Trueflation, offers a more reliable view of inflation, contrasting with government metrics that have outdated methodologies and limited transparency. Trueflation has over 10 million data points, updated daily, and responds to global market conditions. Trueflation is just 0.04% away from starting with a 3, down from over 12% in the middle of last year. And what do we always say about strong jobs and unemployment? It's always strong until it isn't.
All right, well, with all the drama in the banking sector over the past few weeks, the yield curve has become less inverted. An inverted yield curve is a strange thing because you get higher yield for shorter periods, like 3 months or 6 months, compared to 2 or 10 years. Inverted yield curves are temporary. You're not going to get more for 3 months than 10 years forever. So if inverted yield curves more often than not are a reliable harbinger of recession, when it becomes less inverted, that's a good thing, right?
Well, not so fast. Here we have a selection of 7 prior yield curve inversions. You see that there where these lines go below 0, meaning they're inverted. And you see it is temporary, lasting until peak inversion, this vertical line here. This gray line here, that's the current yield curve. Here's another look at that same yield curve by itself. You see that same shape up and then coming down pretty sharply. And you have to get out your magnifying glass, but you see that there? There we go, that's better. We just recently bounced off peak inversion just last Monday, March 20th, largely due to the fears around the safety of our banking system. Whatever the reason, we seem to be beyond peak inversion.
That begs the question, what happens in the market after peak inversion? Sorry to disappoint, but the data shows that really depends. A couple things. All years but one, this green line here is 1998, the market was down at some point during the next 18 months. Not down since the prior market bottom, but since peak inversion, which was just last week. The two worst instances, these two here, are the 2008 global financial crisis and 2000 dot-com crash. I would argue our financial system, meaning the Fed, is in a much better position to handle such crashes, but of course, there's no guarantee with that. The early 70s had plenty of challenges, still down after 3 or 4 years, and the other years, 1968, 1989, and 1998, were up 2, 3, and 4 years after peak inversion.
Lots to think about. Thanks for watching. Hope you have a great week.